Cash continues to flood into the municipal bond market as investors seek tax-free investments amid calls for higher taxes from Washington. According to figures from the Investment Company Institute, mutual funds are receiving about $2 billion of inflows per week in muni space. The supply is still decent. BlackRock says issuance is holding around 5% above the 5-year average. And talk about diamond hands, none of the buyers seem interested in trading. Bloomberg notes that the amount of muni bonds changing hands is at its lowest daily rate in 20 years. My next guest says the Fed may also have something to do with this. Joining me now is Michael Zezas. He's U.S. public policy strategist at Morgan Stanley. Michael, it's good to have you. I mean,
thanks for having me.
When I'm thinking about sort of the buying and hodling of muni bonds, I kind of have all these analogies to crypto coming up in my head, not because of the similar structure, but why is it that they're so attractive to investors right now?
Well, I mean, one school of thought is that there's likely a major tax increase on the horizon, and that's driving a lot of demand. But I think what's more likely at this point is that demand is probably already in the price. You've got muni risk premia at generational lows, and you've got the relative yield of munis versus corporates also at near historical lows. And what we see in the surveys, for example, the one that we published this morning talking to 300 investors, is that they're more likely to be buying because they have too much cash. Only 10% of respondents, less than 10%, said it had to do with taxes. It's just that they're getting too much cash in.
Okay, this is fascinating and worth dwelling on for a second because it's a theme we see cropping up elsewhere. So you're telling me investors have a problem, and that problem is too much cash, right? I mean, that's just such an extraordinary thing to think about. So they're really not motivated by tax efficiency. They're simply looking, and my guess is these are people who already have a lot of stock market exposure, may not be interested in a lot of bond exposure given where prices are, as you mentioned, where yields are. And they're sort of looking around and saying, where else do I go? You know, real estate investments? So it's interesting. Do you think that's what's driving the attractiveness of munis?
Yeah, I think that is mostly correct. And if you think about what's happened for the average investor's asset allocation over the last 12 months, equities have rallied substantially. Bonds haven't moved too much. So your equity allocation is probably greater than it was, creates this natural demand to have duration and fixed income in your portfolio. But what that does is set up a risk in the muni market, which is very richly priced at the moment, that if the Fed's execution on the taper is poor, and if you get rates rising too fast and negative returns, you could get an unwind of some of that liquidity that's basically keeping things at rich levels.
Right. And the irony is that for investors in the long run, they go, all right, I buy, I hold it. I don't care if 5 or 10 years I move on to something else. But in the meantime, to quote the Forbes headline, are states and cities taking on too much debt? If there's structurally higher demand for munis for no other reason than to have something to do with your money, is it allowing municipalities to borrow more than they really otherwise should be?
Well, I mean, certainly conditions are really favorable for borrowers at this point. There doesn't appear to be much of a leverage problem in the market, particularly given all of the money that was aided to state and local governments via the various CARES packages over the past year. But that being said, and that is very much consensus. Our survey, again, 70 to 90% of respondents based on the sector said that they expected credit fundamentals to be stable or improving. So the other risk here is obviously if for some reason Delta picks up and suppresses activity in a little more than it already has, then you'd expect some of these reopening sectors in the muni market, airports, hospitals, et cetera, they could come under pressure as investors start rethinking those narratives.
Yeah, no, it's a great point. We have to go. But I mean, I'm just tempted since I ask you, what budget, is that going to happen? Infrastructure, is that going to happen? What's your latest reading real quickly, Michael, on those major policy pieces?
We still think so. We think it's a fourth quarter event. Obviously, the numbers are in flux, but we think it'll be pretty sizable. It'll have a deficit impact. It'll be one of the things that helps the Treasury yield get to the 180 year-end target on the 10-year that our firm has.
Very, very interesting. All right, Michael Zezas, thanks for your time today. We do appreciate it.
Thank you very much.